Good morning and a very warm welcome to everyone. We have a number of familiar names and faces from across the continent, and we're delighted that you could join us today. My name is Michael Hewson. I'm the Director of Graphene Economics, a specialist transfer pricing advisory firm in Africa. I am delighted to be joined by a good friend who I've known and worked with for over 16 years. Patrick Maweri is the founder of Hepta Advisory, a tax advisory firm in Zambia. Patrick has a range of experience in advisory and in-house tax role. He was recently the country managing partner for one of the big four firms in Zambia. Welcome, Patrick.
Thank you very much, Michael. And it's great to chat with you, and welcome to everybody who's joining on the webinar today. It's a great morning in Lusaka, quite sunny and warm. Thank you very much.
Before we roll up our sleeves and get into the topic for the day, Patrick, Hepta Advisory is just a few months old. I see one of our mutual clients has already been sharing about the terrific support she's receiving from you and your team. Tell us a bit more. How's it been going? Patrick is briefly frozen. I'm sure he'll return very shortly. Okay, we just re-establishing the connectivity. But for our friends, people who've been working with us for a number of years, Patrick has been my go-to person in Zambia for a number of years. If you need someone really, really strong and knowledgeable on the ground in the country, I can highly recommend Patrick and his team. Talking about being excited, I've been looking forward to this discussion. The topic has clearly resonated because there's a large number of people that registered for the event. And we've got good friends from corporates and revenue authorities and advisory firms from across the continent. What makes this matter so insightful is that we got to see the written publication of the judgment at the Tax Appeals Tribunal, and then down the line at the Supreme Court of Appeal. As we know, most transfer pricing matters get settled, so we don't actually get to know all their ins and outs in written format. But on this occasion, we had the opportunity to do so, which was made for a very interesting read and a good opportunity for learning. So, what I'd like to do is, although we are virtual, I want to encourage us to be as interactive as possible. So please do post any questions or comments as we go along in the chat, and we're going to try to respond to as many as possible. Patrick, I see you're back. Can you hear us all right?
Yes, Mike, I can hear you.
Brilliant. Patrick, just very briefly, can you perhaps set the context and tell us a little bit about the timelines of the case and what transpired?
Much, Michael. I think to start with, I will walk you through, the appeal process in Zambia, the audit process. Then I can walk you through the timeline of the case. In terms of the timeline of an audit process, normally the ZRA will ask a taxpayer to provide information. There's an information request sent out, and it's a transfer pricing audit notification. Once that is done, the taxpayer is given a certain amount of time to produce information. Once the taxpayer has responded, generally the ZRA will analyze that information, call for meetings, do on-site interviews, inspections, and so on. And I think if you look at the case, especially the Tax Appeals Tribunal case, you find, I think there is a witness referred to as AW1, who was quite critical in the case, because at this point in the interview process and so on, it's quite important for a taxpayer to manage that process. Then having done that, once the information is exchanged and responded to, the ZRA then will call generally for a closed meeting where all this will be discussed, and then they'll issue a letter of findings. A letter of findings generally will give you a couple of weeks, depending on the issues, for the taxpayer to respond. Once the taxpayer has responded to the letter of findings, the ZRA will issue an assessment, a formal assessment. And I think if you go in the case, that's a section 106, the assumption is that assessment is correct. And once that assessment is issued, the taxpayer has 30 days to respond. The ZRA generally, I think, to their credit, does give extensions because transfer pricing, as you know, can be quite complex. And once that extension is granted, if you're lucky enough to get an extension, you respond to the objection. The ZRA then will respond either confirming what they had assessed or revising the assessment. Once that assessment is revised, then you can move on and appeal to the Commissioner General. If you're not happy with the revised assessment. The Commissioner General then will make a final determination. From Commissioner General, you either go to alternative dispute resolution or you go to the Tax Appeals Tribunal. Professionally, I think we do advise clients to go to the Tax Appeals Tribunal because the ADR process is not binding on the ZRA by law. So I think you could waste time and then not reach agreement or reach agreement that's not binding. So we generally advise clients to go to the Tax Appeals Tribunal. Once that's done, then, Tax Appeals Tribunal looks at questions of fact. I'm trying to cover both sides in the interest of time, Michael. The Tax Appeals Tribunal covers both matters of law and factual matters. And then if the taxpayer is not satisfied at the Tax Appeals Tribunal, as was this case with Nestlé, then you go to the Supreme Court. The Supreme Court generally does look at matters of law unless there was a misinterpretation of the factual matters. And if you look at the timeline for this case, generally it follows what I have described. So there was an audit, there was findings, and then there was an appeal process within ZRA, and then there's an appeal process through the court system. So I think I've covered quite a bit of ground, but the timelines, I think, tie to what I've explained.
Brilliant, Patrick. Thank you. And I think what's interesting for me on this screen, as you can see, it started in 2010, the years under audit and assessment, 2010 to 2014. And then, as Patrick set out, it was the period 2018 to 2019 in the Tax Appeals Tribunal, and then in the more recent years, 2021 to 2025, in the Supreme Court of Appeal. Just a few other interesting timelines along this period is if we look at that slide, the regulations. Initially, the Income Tax Act in Zambia that came in around 2000, and then the transfer pricing regulations, the updated regulations, came in 2018, which is during the period of the Tax Appeals Tribunal, and that was relevant, as we'll discuss a bit just now. The parties also referred to the 2017 version of the OECD transfer pricing guidelines, which obviously was also subsequent to the years under audit and assessment. Patrick, yeah, thanks for talking us through the process. I think it's really helpful and important to understand. And I've often heard legal advisors say, during the course of the audit, think of the end in mind. Think of what facts you ultimately potentially may need to present at the end of the day. Now, whenever reviewing a transfer pricing matter, it's so important to understand the facts at hand very carefully. Now, I must note that our understanding of the facts and what we're discussing today is based on what we saw in the judgments, in the output from the court. So that's the information we're going to be sharing. It's obviously really relevant to consider the nuances of the case at hand. So what we've got on the screen is just an overview of some of the relevant fact pattern. Now, I think transfer pricing cases are always so interesting for me because on the one hand, business is difficult. It's tough. There's lots of factors to take into account, and the taxpayer is trying to convey what's happening. On the other hand, the Revenue Authority does not have the full extent of information that the taxpayer has. And the Revenue Authority is trying to get the relevant information and determine what's relevant in the first place, and sometimes needs to make some assumptions. But we start with the common fact pattern that the parties seem to have agreed to. So the Nestlé entity in Zambia was set up as a distributor for products in 2010. It purchased products. It had various a related party transaction. So it purchased products from Nestlé entity in South Africa, in Zimbabwe, in Brazil, and in Switzerland. Now, 90% of the products were purchased from Nestlé South Africa. At the same time, the group, being part of a multinational group, what's very common is to have shared support services. Now, that's makes sense because it's of economies of scale and also utilizing specialist expertise in parts of the business. So Nestlé adopted this approach. They had some support services provided from Zimbabwe, the Zimbabwean entity that had a bit of a regional role over a few of the entities. There was also support services provided from the South African operations. And then there was some sourcing and invoicing support from a related party in Ghana. So a variety of shared services in order to help the group to operate efficiently. One other transaction that got quite a bit of airtime in the judgment was the IP. So there was an IP agreement from Nestlé South Africa to Nestlé in Zambia, in which case, which stated that the IP was owned, the relevant IP was owned by Nestlé South Africa, but made available to Nestlé Zambia. Some of the other interesting points of this particular case, and what you can see on this next slide is, the operation started in 2010, and the company incurred losses from 2010 to 2014. An interesting aspect, and what I found really interesting, and we will look at this just now, is understanding how different parties look at transactions, how the taxpayer looked, legally and factually what the case was. The Revenue Authority, as I said, because of Revenue Authority doesn't have all the information at the disposal of the taxpayer, the Revenue Authority needs to try to work out certain things along the way. And they looked at which makes sense, the balance sheet of the business as much as they did on the income statement. And what they saw is that the company had relatively limited capital. It also had quite high loans that came in from about 2012 and 2013. So relatively high debt levels for some of the years compared to its equity. Some of the other interesting considerations which got touched on to varying degrees is that Nestlé products, even though the entity only started in 2010 in Zambia, the products were already known because other companies, retailers and the likes of ShopRite and Pick n Pay were cited, were selling Nestlé products into the market, so that the products were already known to a degree in the particular market. But there were no specific internal comparables. So Nestlé did not itself sell to independent third parties at the same level of the market, and there was no internal comparable available. And as I said, Nestlé operated with certain regional roles. So, Patrick, if we now look at this fact pattern, and I think, as I said earlier, it was very interesting seeing the deliberations at the Tax Appeals Tribunal and the arguments raised by the parties, and then ultimately the Supreme Court of Appeal marked the homework of the Tax Appeals Tribunal. Please take us through, give us an overview of the relevant arguments and conclusions that were made.
Thank you, Michael. I think the first issue and the key issue is burden of proof. I did mention, I think that Section 106, which the Supreme Court referred to quite extensively, in a sense, Section 106 says once the commissioner issues an assessment, it's assumed to be correct unless otherwise proven by the taxpayer. So if you look at the first argument there, Nestlé Zambia at a lower court had rejected the placing of the burden of proof on Nestlé. The argument was the burden of proof should be on ZRA to prove that Nestlé's methodology was wrong, irrespective of the assessment. ZRA argued, obviously, the burden of proof lies with the taxpayer because once they issue the assessment in terms of Section 106, that's it. The tax appeals tribunal agreed with Nestlé at the beginning in the first case. But I think if we run to the end of the case in the Supreme Court, and which is the key issue, the Supreme Court seems to have agreed with the ZRA's position that Section 106 is definitive. I have some concerns, obviously, around that, and I think this is something we saw with the Glencore transfer pricing case as well, because Michael, if you look at, for example, a normal tax computation, so add backs, deductions, and so on, those are factual issues. And when the ZRA assesses, it's up to a taxpayer, I think, to be able to demonstrate and say, look, yes, this was deductible, so it's a straightforward process. Transfer pricing is different because transfer pricing gives you a range of methods. So the ZRA could pick one method, taxpayer picks another one. It doesn't mean that either one of them is wrong. So if necessarily then you say, as long as the ZRA, the commissioner, has issued an assessment, it stands correct unless you demonstrate otherwise. That's a very high bar for a taxpayer to overcome. And I wish that maybe the Constitutional Court or somebody somewhere, I think we have clarity around this, because for that transfer pricing, it places a very high burden on a taxpayer. We can probably move on, Mike. I don't know if you have any comment on that one. We can move on to
Patrick,
aggregation.
For me, the burden of proof is very interesting, as you say, especially in transfer pricing, because at the starting point is the burden of proof is squarely on the taxpayer, and the court says that it's on the taxpayer to prove that the transactions are taking place at arm's length price. Now, the regulations and the guidance in Zambia points to the use of other guidance, the OECD transfer pricing guidelines and the UNTP manual. Now, what's interesting is the burden of proof is on the taxpayer to prove that it's arm's length. The OECD and UNTP manual, they say that what a taxpayer must do, or any party, must evaluate and determine the most appropriate transfer pricing method to be used. And there's 5 main methods, but you can use another method if the parties agree to it. Now, you've got to select the most appropriate method. Now, very interestingly, the transfer pricing regulations in Zambia, which came out in 2018, which, as we said, is after the period in audit, but it's instructive for me that that's the guidelines, the rules in 2018. Article 12 says that you need to use to pick the most appropriate method. Article 13 says that you only need to pick one method to analyze these transactions, because having to pick more than one method is overly onerous on the taxpayer. Now, this is very aligned with the OECD guidelines. So paragraph 2.12 of the 2017 version of the OECD guidelines also says, having selected the most appropriate transfer pricing method, the taxpayer only needs to use one method, shouldn't be required to have to use more than one method. So it starts with the burden of proof on the taxpayer to prove arm's length. The taxpayer takes the guidance and selects the most appropriate method, which it did by looking at it transaction by transaction. The Revenue Authority said, well, based on its view of the situation, we've got to consider the overall business, because we've got to look at the losses made by the entity, and we're using this method. And now the taxpayer needed to disprove this method without the Revenue Authority having then disproved this method. So there does seem to be a conflict or tension between this provision that enables, as you say, Patrick, the ZRA to be able to make an assessment, and then the burden of proof is on the taxpayer. But as the starting point, the taxpayer, have they not discharged their responsibility and their onus by following the guidance in the OECD guidelines? So very interesting.
Yes, and I think, Michael, this is without going into the merits of the parties' argument. As I've mentioned, I think because transfer pricing is so judgmental, the bar that has been set by the court is quite worrying, because it means, in a sense, theoretically, there will never be a situation where, as long as there's a disagreement in the method adopted by a taxpayer and by the ZRA, there will never be a time when a taxpayer's version will prevail. If you look at it just, on the factual basis and the court's ruling, and that's worrying, because I think there must be scope for a taxpayer to justify and say, my method is reasonable, and as long as it's reasonable, we can agree that it's reasonable, and the assessment can be defended, the objection can be defended. Thanks, Michael.
Excellent.
Right. I think we can move on to aggregation, which was the second argument. Nestlé Zambia had argued that the transactions should be tested individually, as they were not closely linked. And it seems to me, Michael, if you read, especially the Tax Appeals Tribunal, there seems to be a confusion between aggregation and the application of the general anti-avoidance rule. And there's a lot of reference to step of a transaction and so on, which logic I think generally doesn't belong to aggregation. That's really tax avoidance. But in the end, I think that the ZRA also argued and said, look, it's pragmatic. The taxpayer failed to provide transactional information. The taxpayer argues, look, you didn't tell me that the information was inadequate, but the ZRA's argument was, look, you didn't provide enough information. At the Tax Appeals Tribunal level, the tribunal agreed with Nestlé. I think there's a reference in the judgment where they're saying, look, you can't aggregate apples and books and so on, a bit of an extreme example in the Tax Appeals Tribunal judgment. But if you go to the Supreme Court, then the Supreme Court rules for ZRA because, it found that the interpretation was a bit too narrow, and citing international practice, aggregation was a permissible approach. I think that was the ruling more on practicality rather than the core fundamentals of, the transfer pricing rules. The assertion seems to be there was no information, there was not enough information on the transactions. The ZRA then had the right to aggregate and take a whole entity view. Michael, any comments on that?
Yeah, I found this a very interesting point, Patrick. And as you say, the Tax Appeals Tribunal took one view, the Supreme Court of Appeal then took a different view. At the Tax Appeals Tribunal, the reason given for not going with a transaction by transaction method, because just to recap, there's, as I said, 5 main transfer pricing methods, all endorsed by the Zambian regulations. The taxpayer had looked on a transaction by transaction basis to support this. Now, the Tax Appeals Tribunal, they made a very valid and very interesting point saying that, okay, by looking transaction by transaction, it might still mean that overall, if you consider the transactions all together, it might mean that a company is being overburdened with these transactions. But be that as it may, the regulations and the guidance say, it's sufficient to look at a transaction by transaction. The main reason given by the ZRA for not using the transaction by transaction basis is that there were no internal comparables that could be used. So Nestlé did not sell or transact in an identical way or sufficiently similar way with independent third parties. So because there were no local internal comparables, the conclusion was we've got to use the TNMM. Now that is very problematic because it's binary. It's saying, well, there's no CUP, comparable uncontrolled price method, so we reverting to the transactional net margin method, which again is not supported by the 2018 version of the regulations or the OECD guidelines, which says look at the most appropriate method. I mean, what's common practice is, even though there's no internal comparable, so transaction involving a Nestlé entity with third parties that is sufficiently similar, there were external comparables that could be used. And that's what the taxpayer had tried to do, looking on a transaction by transaction basis, doing benchmarking to see comparable companies with similar comparable transactions, what profit and margin are they achieving, and look to compare on that basis. But again, as I say, because there were no internal comparables, it was rejected. The the Supreme Court finding on this is also interesting, because what it says is that where there's, and perhaps if we just put up the slide again, what you can see in the column at the end under aggregations, is that the ruling from the Supreme Court is that when transactions emanate from a common source, and that then it's appropriate to aggregate. Now, Patrick, I find this interesting because a common source based on this judgment seems to be related parties, because as we said earlier, there's transactions from Zimbabwe, from South Africa, from Brazil, from Switzerland, from various different entities. And so the court ruled that when there's transactions from a common source, which must mean related parties, it's appropriate to aggregate, which is now going to be interesting because there has for many years in practice been an inherent preference to test transactions on a transaction by transaction basis, where a taxpayer had in the past or previously looked overall at the profitability. They've often been requested to say, okay, that's all very well, but let's see the information on a transaction by transaction basis. So here the court's going the other way to say, well, you looked on a transaction by transaction basis. We should have looked on a whole of entity basis because transactions are from many group companies. Now, it's going to lead to very interesting discussions in future periods where multinationals have multiple transactions from different entities. Does this now automatically lead to a view that a whole of entity testing is more appropriate? I don't believe it should, but that's the direction that this point led to.
Yeah, an interesting point, Michael, and I think that if I was a revenue authority, if I was the ZRA, I would be very cautious about that interpretation as well, because I think it works in this instance, but in many other instances, the opposite is probably more appropriate for a revenue authority. As you say, I mean, you have multiple transactions from different sources, and the wide application of common source by the court, I think, is quite worrying and should concern the ZRA themselves beyond just taxpayers. And I think there'll be some taxpayers that will be quite happy with that interpretation.
Yeah, indeed.
The next one, Michael, is documentation requirements. This one is a very interesting one because if you look at the timeline of the regulations which you mentioned, the first regulations were introduced in 2000, in the year 2000. Zambia has had TP legislation for a very long time, probably one of the first jurisdictions on the continent to have had TP legislation. But in those regulations in 2000, Michael, we do not have local documentation requirement. And if you read the case, you see that the taxpayer said, I've provided a master file, I've provided, details of my transactions. And I must confess that general practice, when we advise clients across practice in Zambia, generally we've said, look, before 2018, when the new regulations came, which now required local documentation and so on, please just make sure you have sufficient information to justify arm's length, even if you do not have documentation. After 2018, then you can prepare a local file and so on. Because remember, prescription is 10 years, and some of the taxpayers may not have too much information to prepare full documentation. But, and this is what Nestlé argued. The ZRA's approach was, look, if I ask you for information based on the provisions of the Act now, the particular provisions of the Act, sections 47 and 58, were amended quite recently. When they said, look, if you ask for information, you are obliged to produce it within a reasonable time and so on. So what happened here is that the court took the view, even though the Tax Appeals Tribunal agreed with the taxpayer, the Supreme Court took the view that even if it was not a requirement under the 2000 regulation, as long as it's part of an information request from the revenue authority, you have to oblige. So yes, you were not, required to have a local file in 2000, but because it appears on the list, the information request list that the ZRA has sent, you are therefore obliged to produce it. Again, quite difficult because then the taxpayer has to, I mean, can you imagine we have a 10-year prescription? So today in 2005, the ZRA says I want a local file for, today in 2025, the ZRA says I want a local file for 2015. Can you imagine the information? Some of the taxpayers we deal with, the group could even have restructured. You know, maybe there's a different group altogether, there's been acquisition and so on. 10-year prescription is a long time. Again, I think that's a challenge for taxpayers because it literally just says you can apply rules that didn't exist just because I've asked for them and I've given you the 30-day period for you to comply with my request. So this is uniquely Zambian, Michael, because this particular section says the ZRA can ask for information and you have to produce it. Otherwise, that counts against you in the event of an assessment. I think the court should have been a bit more balanced in the approach, the Supreme Court.
Yeah, Patrick, it is a very interesting point. And although there's specific provisions in Zambia, I do think there's application more broadly beyond just Zambia. And for me, an interesting takeaway here is just, for taxpayers to be very careful, not to say, well, I wasn't legally obliged to prepare it. I mean, yes, I don't think it would have been fair for the ZRA to say, well, you didn't have the document, I'm going to levy penalties because they weren't legally required to apply. But that's different to saying, well, we're conducting an audit and we want to see that this information. And I think it's interesting to understand, as you say, rightly so, Patrick, the constraints of information. I mean, I've seen, firsthand, some of our clients really want to share certain information. As you say, ERP systems change, people come and go, email servers, sometimes things happen to them, and sometimes that information isn't available. At the same time, on the Revenue Authority side, the Revenue Authority is really trying their best to get the information that they need in order to properly apply their mind. So I think, that this point on documentation being available, it often comes up in discussion, and I think it was very insightful that although the taxpayer was not legally obliged to have prepared the documentation at the time, there was a request for the Revenue Authority, and it can't just be ignored and said, relied on that. I didn't legally need to prepare the documentation. So very interesting point.
Indeed, Michael, and I think the takeaway here is the law says you must comply with information requests. And I think there's a lot of homework for taxpayers now in terms of going back because we have a 10-year prescription for transfer pricing. So I think there's a lot of thinking that taxpayers have to do in terms of complying with requests where for periods where local files were not available, because this is settled law now. The Supreme Court is, our apex court as far as law and factual matters are concerned.
Brilliant. Patrick, I'm thinking let's, before we jump into the commercial aspects of the case, some of the other commercial aspects, let's try to get some additional audience participation. And we've got a poll that we'd like to ask everyone to, your thoughts on a particular matter. So in your view, on average, what percentage of startup businesses are still around after the first 5 years? First option, 90%, second option, 70%, third option, 50% around after 5 years, fourth option, 30% around after 5 years. We'll just give you a moment to respond to this, and then we'll share some.
Interesting numbers coming up there, Michael.
Absolutely, Patrick, and you're right. So what we can see is 30% of people say that, 58% say that about 30% of companies are still around. Almost 30% say that about half the businesses have closed. And in terms of the actual facts on this, so according to the 2024 data from the US Bureau of Labor Statistics, about 50% of companies are around after the first 5 years. Now, this just highlights the inherent difficulty and challenge of entering into a new market, setting up and operating, and the fact that startup challenges and even losses are an inherent part of business, the commercial reality, whether a group is part of a related party or a group company. So with that bit of context in mind, Patrick, talk us through some of the other commercial considerations taken as part of these other contentions.
Yes, thank you very much, Michael. And I think that, Paul, if you looked at a business, say a restaurant business, you'd probably find it would be quite interesting in terms of, what it would say. So if you look at the second argument, Michael, is recharacterization of Nestlé. Nestlé argued independent, fully fledged distributor that undertakes all the sales and distribution functions and basically full risk. The ZRA's argument, most of the essential functions were outside. Strategic management, finance, IT, and so on, were not done by Nestlé. Therefore, they argued that the level, it was a lean machine, lean staff, low level of investment. You couldn't argue that it was a fully fledged distributor. At the Tax Appeals Tribunal, and in a sense, both the Tax Appeals Tribunal and the Supreme Court agreed with ZRA, Michael, on this one. They agreed with the ZRA's characterization. I think this one, Michael, as a general comment, the facts probably were quite difficult, a difficult hurdle for the taxpayer to surmount. And I think if you read the case, there's even a mention at some point in terms of the board, the composition of board, setting strategy, and so on. This is a factual issue, and I think that the Supreme Court would have found it hard, and they did mention that they cannot overturn a finding of facts. The Tax Appeals Tribunal looked at the fact and determined there was no way that Nestlé was a fully fledged distributor, and I think that was maintained at the Supreme Court.
Yeah. Patrick, I mean, in terms of the characterization as a limited risk distributor, as you say, I mean, the parties had very divergent views on this. The taxpayer saying, that it did a lot, locally. So it undertook all the sales and distribution activities. It holds and sells the product. It develops customer relationships and third-party network. It has a local board of directors, as you say, and so in many regards, it ticks a number of the boxes. Now, the ZRA, which I found very interesting because it didn't purely look at just job titles or roles and responsibilities. It also, in formulating its view of who really was doing what, it looked at all the information at its disposal. So one of the relevant considerations was, well, the level of capital in the business, and said, well, the level of equity relative to debt, the company didn't have ability to assume all of this risk. Now, that's an interesting consideration because very often, I think we look at thin capitalization and debt to equity. Can we deduct this interest? Because we might have limited equity and lots of debt, and can we deduct the interest? And we look at that in isolation. We might even add back the interest. But now the view as well, or the position taken and a bit of the context from the ZRA was, well, let's formulate a holistic view on this entity's ability to take the risk. Yeah, the interest might have been added back, which it was, so it wasn't actually charged or paid in the end to the group company, but still the level of equity was low. Another consideration taken by the ZRA is who's actually representing the business as the witnesses, because two witnesses were brought by the taxpayer. The one being a finance individual from Nestlé Zimbabwe. And on the one hand, I have a lot of sympathy, and it makes sense because that individual presumably would have good visibility of the transactions and being able to to answer questions on the transaction values and some of the other aspects of it. So I understand completely the reason for bringing that individual as the witness, but the Revenue Authority and the Tax Tribunal, Appeals Tribunal said, but if that person is representing the business, why is someone from Zambia not representing the business? It seems to suggest that the control of the business is from Zimbabwe if that's the person representing it. So there's the fact pattern, and you could look at roles and responsibilities, but then there's these other aspects as well, which were used to shape the overall holistic position, which I found particularly interesting.
Yeah, and I think there are other elements, Michael, where, for example, the amounts paid for management support and so on. And there are two ways of looking at it. I found that the court didn't look at the one, which is, sometimes you could argue and say, look, me contracting to a third party and insourcing those services from a third party doesn't mean I do not have control. It's just a procurement. I'm buying from whoever can provide services. But the court took the view, which I think can also be justified, that, and agreed with the ZRA that you are paying so much for these services. It means all these things are being done outside. Zambia doesn't do very little. Again, I think the lesson here, Michael, is it's complex, but taxpayers must document and must have a structure that justifies, what they are saying. So, one thing I've seen quite a lot with distributors, especially multinationals, is that you have a nominal board, you have a GM in Zambia, probably in the internal structure, his official role is manager, but here they call him director. But when you look at the internal structure, it's probably just a middle-level manager with no decision-making authority, no documentation of that decision-making authority. And I think the court looked at all these elements and said, look, what is really being done in Zambia and what's being done elsewhere? So on a factual basis, this was a mountain, I think, for the taxpayer to climb.
Yeah, absolutely.
The next one, Michael, is the use of European comparables. Nestlé argued on this one that the ZRA's use of Western European comparables was disproportionate. And it's not comparable due to significant differences. And I think it's a valid argument. Western Europe is a mature market and so on. In there somewhere, the ZRA argues and says, look, these actually have lower margins than you. So in a sense, it's a bit more favorable to you. But I think there was an argument of, this is Western Europe. In the master file, it looks like most of the comparables were drawn from Asia, which I think what the taxpayer wanted to rely on. Zambia Regional Authority, the Zambia Revenue Authority argued, there were no suitable comparables that were available. And I think, Michael, you and I sit in many of these forums, conferences with fellow professionals from across the continent. Everybody will acknowledge the difficulty of finding comparables within the continent. But I think the question then is, if you can't find those comparables, does that mean that if a taxpayer comes with comparables from Asia and so on, you should throw them away because there was nothing locally? So I think this one as well, it's a bit more nuanced than the court the view that the court took. In the Tax Appeals Tribunal, they ruled for the taxpayer. In the Supreme Court, unfortunately, the court ruled for the ZRA because, again, the issue is there were no local comparables. You have to use Western Union. Again, this is a tricky one. It might make sense in this instance, but the wider application is so precarious because, the Western European market and our African markets, the risk, the maturity of businesses, stage of business. This was a 5-year business. Its profile and, financials are going to be very different from a 100-year-old business established in the UK, for example. So again, this one, I think they should have been a bit more nuanced. There are instances, Michael, when courts have ruled and said, look, in this specific, without setting precedent, in this instance, I would have probably been grateful if the court had taken that view to restrict its logic and clearly just mention and say, look, in this instance, yes. Because I think if you stretch this reasoning elsewhere, any taxpayer will have difficulties.
Yeah. Patrick, I mean, for many years, as you say, it's been known it's difficult to get comparables in Africa and in many developing markets. So the view has been, well, where do you get comparables from? And some people have taken the view, well, other developing markets is preferable, or Asian markets, Southeast Asian markets are preferable, or Eastern European markets. Now, here the court said, well, actually, if there's no, and again, the court said there's no internal comparables. Now, we said that shouldn't have been the basis for selecting the transfer pricing method. So they said no internal comparables. Therefore, and because there's no local comparables, we need to look at other comparables that do not, that are reasonable to compare to. And they said, okay, well, we'll accept Western European comparables. What I would have found very helpful is, if the court had given a bit more detail as to what criteria they would apply when deciding on is a particular comparable from a particular region reasonable and comparable. Because now we've gone from a situation where previously there was often a preference for Eastern European or Asian or developing country comparables to a case where the court's decided based on Western European comparables. And the court just said that, well, you've got to look at which one's more, if it's relatively appropriate. But what to use? I mean, can a taxpayer now take Western European comparables and use the same bar that the court used to say, well, there aren't local comparables, so we've got these comparables without further evaluation on that. So it's going to lead to some very interesting discussions, I think, in terms of comparables to be used.
Yeah, and I think you make a fair point, Michael. One of the things that commercially we know is that in mature markets, margins are generally lower, and as you mentioned, we've always used emerging markets out of the abundance of caution. In many instances, actually, Western European comparables might be more favorable to the taxpayer. So this one, again, I think the ZRA should approach it with caution, if I was to advise the ZRA, because it's not always that it works out so neatly. And I think the court, by being so definitive on something like this, it's a bit unfortunate, because I think generally we've always said, look at emerging markets. So people go to Brazil, South America, as you mentioned. Very rarely you find somebody using comparables from the US or Western Europe, because those we recognize that very different markets. But in this instance, the court, because it worked for the ZRA in this instance, I think the court seemed to have agreed. And also, as you mentioned, Michael, it's not every business that can generate internal comparables. They are not always available. So does that mean then that, you should get the worst case scenario because the taxpayer can't provide? TP methods allow you to select from anywhere. If you don't have internal ones, you go external and you justify. So giving a statement like, because you do not have internal ones, therefore this, I think it's so sweeping. It's quite precarious, I think, for taxpayers.
Yeah.
Michael, I think the next one deals with, yes?
I'm just conscious of time, and
Yes.
I think there's one more really significant one, and then a couple of less significant ones. We also are getting some really great questions coming through, so appreciate it. We're going to try to respond to those questions. Please, if anyone else has questions in the meanwhile, use these next couple of minutes to put them in the Q&A or the chat section, and we will try to get to them. But in the meanwhile, Patrick, back to you on losses.
Yes, I think the report deals with that. Again, losses. How many businesses have losses? How many businesses collapsed in the first 5 years? Quite significant. Taxpayer argued losses were legitimate business reasons. Due to startup costs, competition, and so on. The ZRA says, look, continuous losses for 5 years whilst the wider M&E group was profitable is a red flag. And it was the primary trigger for the audit. An independent distributor would probably not accept that. Maybe they would negotiate for better pricing and so on. That's a ZRA's argument. Tax Appeal Tribunal ruled for the taxpayer. Supreme Court ruled for the ZRA and found that its position was justified. In the interest of time, Michael, maybe we won't go too deep into this, but I think the Supreme Court's view was the taxpayer had failed to provide compelling reasons, given the wider issues, intercompany charges and so on. The taxpayer had failed to provide compelling reasons why they were in such a financial position.
And losses. I mean, the taxpayer pointed to forex losses being because of currency being a factor that makes it difficult to be able to confirm or project profitability in future periods. And we know currency volatility, it's an external factor out of our control. It's difficult.
Yes.
I think the point that the ZRA was taking is, this company has been repeatedly loss-making, and taking the context of everything else, and they kept pointing to low capital, etc., etc. Their view was that, well, something wasn't right from a transfer pricing point here. So losses, and losses are different across different industries. There are some industries where it takes a really long time. Some industries very capital intensive. It can take 15 years for an operation to become break even. Other industries, not at all. A year, 6 months, before a company, if you like, a more lightweight service type of business, could become break even in a shorter period of time. It's very fact specific. Do you require a large customer base in order to reach break even? So this is very fact dependent and fact specific. Are there other economic or commercial factors? Now, I think the taxpayer tried to argue and explain these reasons. The taxpayer, obviously, the tax authority obviously didn't. There wasn't alignment as to the real factors driving these losses. But my encouragement to businesses who have been making losses is to make sure that you can show that there is this intention, or what's it going to take to get to that profitable position, and how do we demonstrate that? What do we put in place to be able to get there? Because it's a reality. Businesses make losses, but you wouldn't perpetually make losses for an indefinite period of time. So how can you demonstrate that there is an intended end for the losses?
Yeah, Michael, and I think the other issue here on the losses that weighed against the taxpayer is the fact that the ZRA had argued, look, these products that you are selling have been in the market for so long, they are well known, it's a well-known brand. And so that should mitigate against your argument that, you are spending so much time promoting the product, starting up and so on. These are basically mature products in the market. So I think in the ZRA's favor was the court agreeing with the fact that, look, these products are well known in the market, they've been here for decades. And so that should mitigate your startup costs, and then you can't justify the loss making for so long.
And just to throw the cat among the pigeons, Patrick, if I was arguing the counter side from the taxpayer side, I would say yes, the products are known in the market. They're distributed through retailers. However, I am in the country targeting new parts of the market, and I'm trying to penetrate. And that's why I'm making losses. So you can see the arguments on both sides.
And I think the important thing, like you mentioned, Michael, is documentation.
100%. Absolutely. Yeah. Patrick, do you want to just very briefly touch on these last two items, and then we'll jump into some of these interesting questions that we've got?
Yes, I think the last two, the FX not added back. But the ZRA argued anyway and said, look, this is part of the business profile, secondary adjustment we are still entitled to take them into account. The tax appeals tribunal ruled for the taxpayer. There's the Supreme Court ruled for the ZRA on the basis, obviously, they had overturned the assessment and so on. It means implicitly they had agreed. They didn't spend too much time in the Supreme Court on the FX losses. And then the reassessment, again, the Supreme Court seems to have dismissed this. It came up in the tax appeals tribunal. The Supreme Court said, look, a reassessment can be done. Nestlé had objected to the issue of reassessment that the tax appeals tribunal had ordered. I think that sums up quite quickly the last two issues.
Brilliant, Patrick, brilliant. Okay, perhaps if we go to our questions and answers, and please, if you've got further questions, do drop them in here. But Patrick, maybe you can answer the first one. And Mary Darlin, thank you so much for joining us today and for your question, which is a great one. Patrick, in terms of documentation requirements, if a taxpayer is asked to provide a local file or a master file, can a taxpayer share all relevant information to support transactions with related parties instead of a write-up, a particular write-up in a local file or a master file, and then kind of argue it out with the Revenue Authority?
Sorry, Mark, I didn't quite get that.
So the question is in substance. So if there, in this case, was there a request for a master file and local file, but the taxpayer had not prepared it because it wasn't legally obliged to, could a taxpayer potentially have provided all the relevant information, maybe not in the structure of a master file and local file, but provided the relevant information and then argued it out with the tax authority, or at least discussed it with the tax authority?
Look, theoretically they can, and this is the approach that we've taken before in terms of advising clients for periods when there were no formal documentation requirements. But I think, as I mentioned earlier, the court seems to have taken the view, if an item appears on the ZRA's list, just do it. I think our advice would be, from the abundance of caution, generally for transfer pricing, you have a 30-day period, to provide information. You can ask for extensions. Look, I don't know, run around and try and prepare a form, formalize that information into some form of a document. If you had asked me this before August, before this ruling, I wouldn't have said that. But the ruling seems to suggest if it appears on the ZRA's information request list, you must provide it, because then the wording of that provision is quite restrictive. Essentially, the ZRA could even disagree or just reject anything you provide if it's not in the format they've requested it. Very often, obviously, they do look at it, they're very reasonable. But I think, strictly speaking, a malicious actor could take an extreme interpretation and just say, look, I don't want it to ask for a local file.
Brilliant. Patrick, and I mean, from my experience in helping on transfer pricing matters, I often find that, revenue authorities sometimes, it feels requests are unreasonable. But other times, if you engage and you discuss and you explain constraints with information, I've encountered many occasions when revenue authorities have understood that and agreed to different types of information being provided. So I think that discussion, and I think that is the heart of Mary Darlin's question, discuss with the revenue authority, get on the same page. Don't just say, I don't have the information or can't provide it. Discuss, what other information could be provided. I am conscious of time, and we want to be respectful of everyone's time. There were some other questions, and we appreciate it. We will respond to you just in writing after the webinar. But I would like to just express a warm thank you to everyone for taking time to join us, and we really, really appreciate it. Patrick, it was a blast. I thoroughly enjoyed it as always, so thank you so much. We at Graphene Economics and Hepta Advisory, we do our best to add value to businesses operating across Africa. One of if you found this helpful, then something else you might find helpful is we are running a transfer pricing survey, our annual survey. please, in the chat, you'll see we're posting a link to it. And please take a few minutes, complete that survey. We will then share our findings on that with everyone who has responded early in December, and hopefully share some further insights on transfer pricing in Africa. On that note, Patrick, everyone else on the call, thank you so much and have a wonderful day.
Thank you, Michael. Thank you, everybody that joined us today. Have a wonderful day. It's been great talking to you, Michael, and discussing this case with you. Thank you very much.
Bye-bye.